I'm Nick Aves from Purely Finance. We're mortgage brokers and I'm a licensed credit advisor. We specialise in helping investors of all levels, from people just looking to get into the investing market right up to people that are very experienced investors doing very large developments. Today I just wanted to start talking a little bit just about the money fundamentals of how money works, why you'd borrow money to invest, and the different types of loans you can have, because if you speak to somebody like my father from his generation, all debt is terrible, all debt should be paid off straight away. So I talk about debt and in three ways, and the types of debt I talk about, the first type I categorise as bad debt or bad loans. I then talk about good loans, and then I talk about excellent loans. And what I mean by that is, by understanding these three types of loans and getting them right in your head, it will help you with the way you structure all your finances. So the first type of loan that we talk about when we're talking to our clients that's a bad loan is any type of consumer loan. So anything for an asset that doesn't go up in value. So we've all heard the story where you buy a brand new motor car, you take it round the block, you bring it back to the dealer and you say, you know what, I made a mistake, I'd like to trade this car back in. Well, guess what? They're going to give you a fair bit less than what you just paid for it a few hours beforehand. So the asset is going down in value. The other thing is that the money that you borrow to buy these assets can often be quite high. So higher than a home loan, higher than an investment loan. So with bad debt, which is consumer debt, when we're looking at clients and structuring their debt, we say that's the debt we want to pay down first. We want to knock that debt off as quickly as we can. I'm not suggesting that you can go and buy a car for cash. That's unrealistic. So people do need to borrow money, but we want to borrow the money responsibly, and we want to have an ability to pay that down. There can be some exceptions for people that are self-employed and are buying a work vehicle, because that can then be a tax-deductible debt. But generally, we want to get these loans down. So things like credit card debt, Harvey Norman is a classic, the interest-free. If you go past the interest-free period, it becomes very expensive. So we want to make sure we just got that under control. Now, for anybody that's bought a house in the past, I'm sure you'll agree that it makes sense to borrow money to go and buy your home. Because if you are trying to save the money, as fast as you save, it appears that the houses tend to keep going up over time, and you can never get to a situation where you can actually pay cash for a house. And certainly that anybody that's bought a house some time back will now have equity in that property. So it does make sense to borrow money, in my book, to borrow money to buy a home. But excellent debt, and this is something that my father can't get his head around, can be money that you borrow for investing. And I say it's excellent debt because basically what you're doing is you're using somebody else's money, and normally a lender, to try and invest that money to get a better return than what the money is costing you. So you're using somebody else's money to try and get ahead financially. The interesting thing is, and I should have mentioned earlier, this is just very general advice. So obviously you need to get specific advice for your own situation. But generally, if you had a home loan today, and it would be a very small home loan, but let's say you only had a home loan of $200,000, which is quite a small home loan. The thing that is staggering is that you could easily borrow $1 million for investing, and the cost to you for those borrowings are very similar. And I suppose that's the thing that always people say to me. They say, you know, look, we've got some friends, they're in a similar situation to us, they've got a similar sized family, we know they've got a similar sized mortgage, yet they've got 3 investment properties. How on earth can they afford 3 investment properties when we're battling just to pay our own mortgage? And it's because investment debt can be so much cheaper to service than a home loan debt. So for example, here with the home loan, the person that's making the payments is you. You get paid, the tax gets taken out of it, and then the money that's left, you pay all the bills, including your mortgage. Over here, when we're talking about excellent debt, it's a little bit different. Because if we're talking about investment properties, you go and buy a little investment property, all of a sudden you get a tenant in there, and the tenant is helping to pay this mortgage. So the tenant would pay about 60%. Now these figures are generalised figures, but it's to give you the concept. It could be a little bit more now because interest rates are historically low, as I record this in August 2014. But at the moment, the tenant's paying a fair bit of the mortgage, and it can be more than 60%. The other thing, depending on your situation, is that, and also the property you buy, but there are tax benefits for buying an investment property. So the tax man is helping you pay some of this debt back. And if we said 20% there, that's 80%. That leaves you here, and your contribution in this example would be 20%. 20% of $1 million is 200,000. So I wanted to just sort of talk about that concept because some people have a concept that all debt is bad and all debt is the same. All debt is not the same, and when we're looking at structuring your loan and structuring your cash flow, it's very important we take that into consideration. This brings me perhaps to the next thing, is why would you borrow to invest? And that's really a thing called leverage. And I'll just quickly show you what I mean by leverage. Leverage is this: if you had $100 and you invested that $100 for a whole year, and let's say you got 10% on that money, which is quite a high figure, but it's a nice round figure, that means at the end of the year you would make $10. Okay? And that's at a 10% return. Now if you increased your investment to say $1,000 and you had the same rate of return, 10%, you'd now be making $100 for the year. So it's the same rate of return, you've just got more skin in the game. You've got more money invested. And if we increase that, obviously this is just going to keep going up. 10% as well, we've now make $1,000, and so it goes up. If you had $100,000 invested, at 10%, we've got 10 grand. And if we had $1 million invested, at 10%, you make $100,000. So I think this is a key concept to understand when you're borrowing money and you're looking to increase your leverage, because people get scared off from investing because they hear horror stories. And horror stories are often where people start to invest in things they don't understand, by people they don't really know, and they can get ripped off. So what we're not talking about here is trying to get a sexy return. We're not talking about trying to double your money or find some magic bullet that's going to end all your financial woes. We're talking about a reasonable return, whatever it is, and we could change these figures to 5%, it wouldn't really matter. It has the same sort of change. But what we're looking to do is to increase the money you've got invested. And we all hear the stories about, you know, the rich get richer, it takes money to make money. Well, when you're starting out, slowly but surely, if you can get into a situation where you can borrow some money, and if that debt is at a level that is, you've got the ability to service and you're not over borrowing, and you're going into an asset that's been well researched, using some professionals to help you do that, well then borrowing a slab of money that you can leverage to get a return will certainly help you on your way. It works in reverse as well, of course. If the investment goes down 10%, well guess what? If you've got $100 and you only lose 10, if you've got $1 million, you lose 100 grand. So it is important that when you're looking at investing, we're looking at time frames, we're looking at trying to minimise your risk by getting some good expert advice to help you along your way. So that's just a little bit about money, just a few key concepts we talk about, and I'll talk to you later on about some strategies for developers when they're looking to borrow money. Thanks so much.